These are the top stories at this hour here on NDTV Profit, and we'll get to you more details through the day on all the developing stories. We continue with BioCell. Over to Ashu.
Thanks for that, Bianca. Well, let's resume our Q&A with Alok on his top stock ideas. Alok, third one, KEC International. I was looking through the valuations of KEC compared to Kalpataru, which is also a peer. Valuations of Kalpataru look more attractive.
Yeah, but I think, KEC, because of its acquisition, the SAE acquisition, I think looks a more safer bet at this time, because you have a large, you have exposure to both domestic as well as international markets. And we are positive on Kalpataru also, but I think today we'll speak about KEC. And, so KEC, as I said, but let me tell you one thing, we went wrong on KEC's numbers. And we were factoring in a much higher growth, top line growth, but unfortunately implementation problems, execution problems, all that has led to a slower growth in top line. But we believe that they will get about 17-18% top line growth in FY12 and also FY13. So factoring in that, we believe that they will get to an earnings per share of about 9.5-10 for FY12 and about 11 for FY13. They have a strong order book, 78 billion as of now. Very strong on the transmission side. They have diversified into, as I said, in the railway business, in the underground cable business, which has broken even, which is turning around. SAE Towers already is doing very well, as I said. They have one advantage is that SAE's margins, EBITDA margins, are higher than KEC's domestic operations. So that will, nullify any downside in the domestic EBITDA margin. But we believe that they will get to about 10.2% EBITDA, sustained EBITDA going forward. So if you do a top line of about 5,306 crore, which is about 53 billion for FY12 and about 62 billion for FY13, you are talking of about an EBITDA of about 5.6 and 4.7 times FY12, FY13, which is not expensive looking at the overall requirement of the transmission infrastructure in India. A strong ROE of about 20% plus, strong ROC about 19-20% plus, sustained EBITDA margin of 10%, presence in the domestic market as well as in the international operations. I think we believe that from the current levels, there is not much downside to KEC. It was 79.80. You're factoring in everything, every damn thing. So unless something goes wrong, I think KEC from the current levels gives you a good, sustained 25-30% upside over the next 12 to 15 months. And by the time you will start factoring in FY13 numbers, so I think it's a good bottom-up approach. Downside nahi hai. You've got 79.80, looks a very good, strong buy from the current level. So we are reiterating buy on KEC as we are reiterating buy on Pratibha and ICICI Bank.
All right, Alok, thank you so much for joining us. Always appreciate your time and interesting stocks there. KEC, ICICI, including a couple of other stock ideas. Great to have you with us. Have a wonderful weekend. We'll see you next week right here on the show.
Thank you very much.
Well, of course, it's Friday and it's 12 o'clock, which means we'll slip in a quick commercial break and we'll come back and we'll be taking up all your mutual fund and insurance-related queries. We've got with us Anil Rego, CEO and founder, Right Horizons, and Jayant Pai, VP and CFP of Parag Parikh Financial Advisory Services, joining us after this break. Well, I've just been of course, we'll be taking you through that, but we've got KC Chakraborty who's actually addressing that press conference. Let's quickly hear out what he has to say before we take that break.
We must understand that, and that's why we are saying banks must give the educational loan. Today banks are giving about more than only 2 million people, something more than 2 million people, say 40,000 crore is the educational loan, we require 10 times more. Now, we can give that educational loan to students, we can send them to school. The second challenge in the education is where are the good quality schools? 100% mark for the last 2 days I have seen the debate is taking place with 100% mark person is not getting the admission. So we must also understand we have to create the educational infrastructure. And again here the banks and the captains of the industry must come forward, and today education, higher education is permissible. In a PPP sector, infrastructure is permissible. How we can create the good education
Well, that's K.C. Chakrabarti, the Deputy Governor of the RBI. Pretty animated conversation there, but talking about the concerns in the education space. We'll take a break now. We'll come back and address your mutual fund queries over the next 1 hour with our panel of experts.
Welcome back. You're watching BioCell. We've also now got with us Sapna, who's actually joining us on the phone line to talk about the takeover code. In fact, the SEBI board meeting is actually scheduled for the 30th of June, and they're likely to take up the issue of the takeover code, and the trigger for open offer could actually go up to 25% or more. To get more details on what has been said and what the expectations are, let's go across to Sapna. Sapna, I believe from your sources you found out that there could be a meeting as early as the 30th of June to take up the issue of the takeover code. What are the sources saying to you?
Well, yes, that's the tentative timeline for the next SEBI board meeting. And yes, the assistant committee report, which basically means the takeover code recommendations, are going to be discussed. He himself will be part of the board meeting. Well, apart from this, the finance ministry's view is this, that yes, we can accept this 25% trigger for an open offer, could be even higher. And well, if it's around 24.99% or 25% or whatever, I mean, that's the time when it gets triggered. However, the government is very clear that the other part of the recommendation, the concurrent recommendation, that once the trigger is in place, the company will have to make a 100% offer. That is something that the finance ministry has clearly shot down. They are not in favor of that recommendation. What they are saying is that it could be anywhere between, say 40, 45, 50%, so on and so forth. Now, that is something that we discussed in the board meeting. So as of now, they're okay with a higher trigger of 25% or more, but not in favor of an open offer of 100% in one go. That's something they're not accepted clearly, because he's saying that, I mean, the sources are saying that this will put the Indian companies at a disadvantage as compared to the global players, the other MNCs, which have a higher financing power in terms of, like, a lot of banks are willing to finance them for takeover and all. Takeover financing is very clear over here. We don't have a similar structure as far as PSU banks are concerned. So that is one concern that has been put forward. The other concern, of course, is on the issue of non-compete fees. Now, that again, he said there are very divergent views that have come up. So that is something that again will be decided in the board meeting.
Sapna, I should decide just a quick follow-up question. The report which you've just sent suggests that the trigger for open offer could go up even beyond 25%?
Yeah, that's what he said was 25% or more.
Okay,
that was very clear.
So there's a probability that it could be even higher than the current one.
Yes. And in any case, Ashu, 25% is okay with the government. The finance ministry is okay with that.
All right, Sapna.
But what they are not okay, is that the 100% thing. That in the first go itself, you have to go for the entire 100% stake. That is what they are not in favor of. And those limits will be decided in the board meeting.
All right, we'll keep track of that, and of course, Sapna will be keeping a track of that important development. Mind you, the change in the takeover code has been hanging on for the last 1 year, almost 1 year now. Mind you, it was more than a year ago when these new proposals were again highlighted. After that, there's nothing that has happened, at least on this front. So finally, some headway could be made as far as the whole takeover code is concerned, the SEBI takeover code is concerned. Let me quickly introduce who will be joining us now on the mutual fund segment. We have with us Jayant Pai, who is VP and CFP at Parag Parekh Financial Advisory Services, joining us now from Mumbai. Jayant, thank you so much for joining us right here on the channel. Let's bring in our first caller. Vasantha is joining us now from Bangalore. She's a homemaker. Vasantha, hi, good afternoon. Go ahead, ask your question.
Good afternoon. I'm holding actually Reliance Vision Fund for initial amount of 45,000. Hello?
Yes, I can hear you. Go ahead, please.
And Reliance and Fidelity India Special Situation Fund was an SIP which I made it for 12 months of 1,000 each, and initial amount is 12,000. And Tata Infrastructure, I was holding 5,000 rupees, 5,000. I just want to know whether I can hold on still or wait for some more days, or shall I get out of that?
So only one fund is through the SIP route, rest others are not, right?
Rest others are?
Rest others you've invested on a one-time basis, right?
Yeah, lump sum amount.
Okay, fair enough. Jayant, again, infrastructure as a space hasn't done anything, so I'm assuming the scope for improvement hasn't been much. But what about the others? What should she do with her portfolio right now?
Yeah, Ashu, actually, whenever we structure a portfolio, we divide it into two segments. One is the core segment and second is the supporting or satellite segment. The core segment usually comprises large cap diversified equity funds which have a variety of sectors and stocks within them. Now, Vasanta's portfolio comprises actually, in my opinion, more of supporting funds, especially Fidelity, Special Situations and Tata Infrastructure. And only Reliance Vision conforms to the core classification. So in case these three are the only funds that she owns, she should, in my opinion, move out of both these supporting funds. In case of Fidelity Special Situations, she could switch to a good core fund, which is Fidelity Equity Fund, which is from the same fund house. And in case of Tata Infrastructure, she could move to some a proven multi-cap fund such as DSP Equity. Tata Infrastructure has actually performed very well within its segment, but unfortunately whenever you choose such sectoral or thematic funds, the downside is that if the entire sector does not perform, then your portfolio too underperforms. Reliance Vision is fine, it has had a rough patch, but now it is improving, so I think she could hold on to it.
Well, that's the call coming in Vasanta's portfolio. Jayant Pai clearly indicating the call on it. Next up, we've got with us R.L. Jain. Okay, well, we'll slip in a quick commercial break. We'll come back and go back to all your mutual fund and insurance related queries, so stay with us. Welcome back. You're watching Buy or Sell. We've got another caller calling in right now. R.L. Jain calls in. In fact, he's 48 years of age, calls in from Gujarat, and is a doctor by profession. Hi, Dr. Jain. What's your question?
I have my portfolio is already with you. I have two basic questions to ask. My first question is, how often one should review the returns from mutual fund schemes? Which returns one should take, whether 6 months, 1 year or 5 years? And what should be the criteria for comparing the returns? That is my first question. Second is, when the returns are high, one is tempted to continue holding units. At what point partial or full profit should be booked to make money from the mutual fund scheme?
Right, Mr. Jain, we've got your query with us. Jayant, you heard Mr. Jain's query. Firstly, let me just take you through his portfolio very quickly. He owns Birla Sun Life, Frontline Equity, Franklin India Blue Chip Fund, Franklin Prime Fund, Franklin Prime Plus Fund, DSP BlackRock Top 100, HDFC Top 200, HDFC Nifty Index Fund, Reliance Diversified Power Sector Fund, Reliance Regular Saving Fund, Reliance Banking Fund, Tata Pure Equity, SPI Contra Fund, Sundaram Select Mid Cap Fund, UTI Opportunities Fund, UTI Dividend Yield Fund, UTI Master Share, ICICI Pru Dynamic Fund, Reliance Growth Fund, Franklin India Growth Fund. So that's a fairly large portfolio. I mean, I'm running out of breath just running through these names. Well, first, Jayant, help me with the fact that is this portfolio too large? Because on first look, I'm assuming Mr. Jain is tracking this himself, so it probably gets pretty difficult to look at so many funds, right? Firstly that, secondly he does have exposure to sector specific funds as well, and I know you believe that diversified funds are always the better way to go, especially if you're handling your own portfolios. Yeah. The investors talked about what is the criteria that he should use for comparing two funds, how often should he be reviewing his mutual funds, and the other point that he mentioned that there are funds that are very seasonal in nature, so what a fund that does well last year doesn't necessarily mean it's going to be a top performer this year. So when do you, how do you book your profits? When do you exit the fund at the right time?
Okay, let's take this in parts, because I mean actually this list reads more like a laundry list than a list of mutual funds. It's absolutely humongous. So first what he should look at is streamlining this so that he can track it better And I have a suggestion that he just retain say 5 funds out of this, and 5 truly diversified funds, in the sense that each one has a certain set of different characteristics. So my recommendation for him would be to retain Franklin Blue Chip, Franklin Prima Plus, HDFC Top 200, UTI Dividend Yield, and ICICI Dynamic. So this will give a differentiated flavor to the portfolio. As for the rest, he could sell these once his 1 year holding period is over, so that he does not have to pay any exit load, nor does he have to pay any long-term capital gains tax. Now regarding the second thing, yeah, it is true that monitoring a portfolio is difficult, but today there are a lot of options available. For example, if he goes to the website valueresearchonline.com, that provides very good metrics for tracking. But I think that he should not duplicate a lot of effort which they already do. So 2 metrics which I could suggest to him is one thing known as alpha, which is the risk adjusted return. So it's not just return alone, but how much risk a fund takes to earn that return.
Right.
So alpha will encapsulate that. And the second is a simple metric known as standard deviation, which captures the volatility of that return. So it's not just the return again, it's how volatile the fund is. And 3 things which I often use while to know whether I should move out or not. One is a change in the fund manager, because this is a very personality centric industry. So if there is a change in the fund manager of a particular scheme, the performance could flag. So that's one thing. Second is if there's a change in the attributes of the scheme. For example, if there have been cases earlier where an internet fund or a technology fund morphs into a diversified fund. So in such a case, your very objective could be defeated. So that is one more thing. And third is, if a scheme continuously underperforms its own benchmark or its relevant peer set for a period of say a year or so. And regarding his review question, I think once a year is fine. Okay. And also book profits only when you really require the money, and don't try to market time.
Okay. Well, that's of course Jayant's view. Mr. Jain, if you heard that, he said reduce your exposure to the number of funds you hold. Franklin Blue Chip is what he said to hold on to. Franklin Prime Plus, HDFC Top 200, UTI Dividend Yield Fund, and ICICI Dynamic Fund. But he also advises that exit the other ones only after you've held it for a year to avoid the tax liability on that one. Comparisons could be made by the methods he suggested, and of course he also does say that the flair of a fund manager could also a number of times determine how well a fund really does. Anil, what is it that you make of it? How often should a portfolio be reviewed? Fairly large portfolio is what Mr. Jain holds. What is it that you like in this fund? What is it that you like in this portfolio, and what is it that you don't? Because he's also got exposure to quite a few sectors. And of course, what is the kind of sort of parameters that he can use in order to decide whether or not a fund is doing well?
Sure, I also agree that we have a very large set of funds out here. Maybe 6 funds is what I would not go above, and look at the different categories there. So okay, choose. So in the large cap fund, maybe I will do a HDFC equity or top 200. Maybe one will do a Franklin India Blue Chip type of fund there. And the mid cap, do something like ICICI Approved Discovery. One can even hold stuff like Sundaram Select mid cap there. I may also just want to have a little conservative option, like to say if you have a dynamic PE fund of Templeton to add in there, or even a balanced fund there. So that's broadly what I would suggest on the fund side. In terms of how do you look at funds, I would first maybe talk about how does one even choose a fund. I would look at first the fund house. I would then look at who's managing the fund, what is his track record out there, then get into fund performance. On the fund performance, again, typically most people just look at 1 year, 3 year, 5 year type of returns. One would go a little beyond that. First of all, look at slightly long-term returns. Yeah, we already spoke about the risk measures there. Look at some of them. But even on performance itself, maybe look at how consistent the returns are. How is the fund done, let's say, when markets fall? To see, is it doing only very well in a good time? How is it doing in a bad time? And then get into factors like what are the costs of the fund, what are the FMC, fund management charge, etc. there. I think one other question that he asked about exiting his fund. If you ask me, that's the more difficult part. I think most people, I think, are broadly right on when to invest, but I think they miss out on when to exit out there. So I would like to look at it in terms of what is the long-term return that one is getting. Definitely not a 1-year period or a 6-month period. Look at it over maybe once in probably every 3 to 5 years. Maybe an exit is something which one can look at out there. And because and how do you go about it? Look at what is, let's say, the market return over that period. Has it been, let's say, really great? Have we had a 25% compounded return for the last 5 years, which we have seen in the past? And that point, one sits back and says, yeah, let me take some money out of this, because actually the index has, in the long term, over 15 years, maybe delivered around 15% plus or minus out there. So let me take some money away and put it back maybe through a systematic transfer. So that's one input that I would suggest for exiting funds.
Okay, that's a pretty comprehensive analysis from both our experts. It's time now we take a quick break, but Priyanka is standing by on the news update.
This is NDTV, and you're watching NDTV Profit.
Welcome back. You're watching Buy or Sell, the mutual fund special. Let's welcome in our next caller. Sugandhi is joining us now from Chennai. Sugandhi, hi, good afternoon. Go ahead, ask your question.
Hi, good afternoon. See, it is always said that 70% should be invested in core and 30% in satellite. So I have chosen the following funds and I need advice from you. See, in large cap, I wanted to choose one among the three, like Franklin Blue Chip, ICICI Pru Focused Blue Chip, DSP Top 100. And in large and mid cap, I have chosen HDFC Top 200 and UTI Dividend Yield. And in mid cap, I wanted to choose one fund out of IDFC Premier Equity or HDFC Mid Cap Opportunities. And in tax, I wanted to choose any two funds, either Franklin, Fidelity or HDFC. And I want to invest in one sector fund. It can be either an index fund or Magnum FMCG and Reliance Pharma or Reliance Banking. And one more question is, see, HDFC Equity and HDFC Top 200 is done in the same manner. Is it essential to have one more equity fund when we are having a HDFC Top 200?
Sugandhi, I'll ask the question to the guest, but let me, congratulate you on the awareness level that you have. Not many people have this kind of an awareness level when it comes to their investments. They tend to just invest and forget about it.
Money control, because I regularly see to the.
All right, let me get our experts to talk about that. Jayant, let's get your perspective. That's a very, very well-informed investor.
Yeah, Ashu, I'm truly impressed. But I think she's done some good homework, but unfortunately her current portfolio, actually it shows something else. For instance, this ICICI Pru Discovery is actually a supporting fund. See, I'm going by Value Research's classifications. So as per them, ICICI Discovery is a supporting fund, and also Reliance Pharma being a sector fund, it has certainly done very well. But like this 70-30 classification of core and sector, core and supporting. So I think if we go by that, her current portfolio is more of supporting rather than core. So what I have suggested is that she retain Birla Dividend Yield and HDFC Equity. Her question on whether, I mean, yes, certainly HDFC Equity and Top 200 are managed in a similar manner. So I have seen many portfolios having both of them. So I usually, advise that they should stop one of them and either merge the two or invest in a different fund. So in her case, she could retain Birla Dividend Yield and HDFC Equity. Reliance Pharma is a sector fund which she has said she would like to invest in one. So she could continue in this. But in case she wants to move out of it, she could move to Prima Plus also. But anyway, now let's retain Reliance Pharma. Sundaram Midcap is something which has been an underperformer for a long time. So I think that if she wants to move to another midcap fund, HDFC Midcap has performed very well over the past 3 years. IDFC Premier Equity has performed well for a longer period. So both of them are okay. You could choose either one of them, but switch from Sundaram Mid Cap. And ICICI Discovery, see, her portfolio does not contain a pure large cap fund. So that's why I suggest that she move out of ICICI Discovery and switch to DSP Top 100, which is a pure large cap. So her portfolio could look like this: one DSP Top 100, Birla Dividend Yield Plus, HDFC Equity, either IDFC Premier or HDFC Mid Cap, and Reliance Pharma. So that way 20% will be into a sector fund, which usually is a good enough percentage, and the balance will be into say primarily core funds.
All right, Anil, your opinion on how the investors should streamline a portfolio?
Yeah, first of all, congratulations to Gandhi for your thought process on how to go about your investing, and I think even the funds that you have chosen are reasonably good funds there. I agree that today your focus is a lot, at least on your existing portfolio, is a lot on the mid cap side. So if you ask me, I would just do one or two small changes there. Maybe the Sundaram Select Mid Cap, move it to a Franklin India Blue Chip Fund, and I think that should take care. Pharma as well, I'm not a fan of sectoral funds there, so one would want to keep a watch on that. However, at this point of time, maybe it's good to have a defensive sectoral fund there. So I would want you to maybe take advantage of it and watch it over the next 6 to 12 months, and maybe go and move that into another large cap fund. Like DSP Top 100, which was suggested, is also one thing that one could do. I think you already have Discovery, you have Dividend Yield Plus of there, so both of them are decent funds. So I think that would take care of it, and you would then have your 70-30 ratio that you were looking for.
Right, that's the call coming in on the portfolio. Next up, we've got Jayant Pai. He's about 57 years of age, calling in from Mumbai. Hi, Mr. Pai. How can we help you?
Ma'am, I had got two inquiries about mutual funds. I had bought DSP BlackRock Top 100 Equity Fund Growth in November at 101.16 paisa. And secondly, I had bought Religare Banking Fund Dividend Yield in November at 16.79 paisa. But since then, NAV has been going down. So should I hold or should I switch to other funds?
Right. Anil, what is it that you make of Mr. Bhave's portfolio? What are you advising him to do, hold or exit?
Sure, I think for the two funds I asked his opinion on, one is the DSP BlackRock Top 100. I think it's a good fund to hold for the long term, yes. If I look at it over the last few months, let's say versus HDFC Top 200, maybe it's underperformed a little there. But you would need to give some time to all of the funds to, there would be periods of underperformance for all of them. I would still continue to hold it. Maybe if it continues to underperform over a longer period of time, then maybe one could do a switch. But today it's maybe doing on par with the market, so nothing to worry about there. It's also a large cap, so in case markets do fall, then this will also protect him to some extent there. My concern is with the Religare banking sector fund, again, banking definitely is not a sector to be holding at this point of time, considering the global scenario, considering where the interest rate scenario is, and inflation is stubbornly remaining high. Banks also have taken a hit that SB interest rates have been increased there, so that will again add margin pressure. So I would definitely go out of the Religare banking sector fund and probably move into a large cap like blue chip, Franklin India Blue Chip Fund.
Right. Jayant, what is it that you make of Mr. Bhave's query? Is it worth holding on to? Do you like any of those two?
Yeah, actually, the first so-called error that he has made is to buy it in a lump sum. So that itself makes him more prone to these fluctuations. So unfortunately, he bought it at the highest when the index was around highest. So that is something which he can remedy by initiating an SIP. That's the first thing. Otherwise, in terms of fund selection, top 100 is fine. In terms of Reliance banking, Religare banking, actually most of these diversified equity funds already have a large chunk of financials, and most of them hold over 20%. So that's why he could move out of this and maybe choose a pure mid-cap fund, say an IDFC Premier Equity or an HDFC mid-cap. So in case he has only these two funds in the portfolio, so he'll get some sort of a diversification, one pure large cap and one pure mid-cap. Getting into pure financial based sector funds, say banking funds, I think is really it's a duplication, because most of the diversified funds already have an overdose of financials.
Right.
So
Right, that's the advice coming in from Jayant. Really, that's the call, pardon me, yes, Jayant, and that's of course from Mr. Bhave, who's called Jayant as well. So that's the advice from Jayant and Anil both. Well, we'll slip in a quick commercial break right now. We'll come back and we'll continue taking up those queries, so stay with us.
Welcome back. You're watching Buy or Sell. Our next query is from Namish. Holds HDFC Top 200. It's an SIP route. He's investing 3,000 rupees a month. Reliance Growth. He has an SIP of 3,000 rupees. He has HDFC Tax Saver and Fidelity Tax Advantage Fund are the investments which he currently has. And also from an insurance point of view, he has two plans. One is Kotak Term Plan, cover of 50 lakhs. Then he has a Max New York Life ULIP plan, cover of close to 15 lakh rupees. And he wants to know, is this a right choice for him at his age? He's currently aged 20 years old. Jayant, first to you. I'm sure you must have had a detailed look at his portfolio. I think most of these funds are fairly okay. They're diversified, so he doesn't have exposure to the non-performers right now. What's your opinion on how should he look at his portfolio? Should he maintain status quo or perhaps there is minor rejigging required?
yeah, actually status quo is fine, because all his funds, I mean, they conform to all the usual parameters. Like his DSP Tiger fund, which is the only sector fund that he has, that is he's not overweight on that. And only thing with regard to tax saving, what I usually tell people is that don't go overboard on tax saving funds. Integrate it with, first of all, your overall asset allocation, and second is, you are getting a tax benefit of only up to 1 lakh rupees under Section 80C. So don't go overboard on such funds. So other than that, and also his insurance cover is adequate for his age. Of course, he may have to increase it as time goes by, and he has chosen a term plan, and which I think in future also to supplement his insurance cover, he should use the term plan option only.
Okay, and Anil, in your opinion also, does the portfolio look pretty good? What's your take? Should he rejig a little bit?
Sure, I think it's a well thought out portfolio. So even if you look at, he's taken his term cover, he has a range of funds out there. So what my suggestion is, from what I've seen, some of the mid-cap funds probably can be moved to a little better performing ones. Of course, DSP Tiger is something that, I would probably get out of at this point. Maybe move to an ICICI Approved Discovery instead of that. Reliance Growth, maybe watch the performance for some more time, and if it's not doing well enough, then you have a HDFC mid-cap there. Maybe these are the couple of suggestions there. Yes, on his insurance, I think he's done a good job taking the required term cover there. As let's say he adds any liabilities, home loans, etc., he would need to add on to it, or as responsibility keeps going up, then he could add on to his term cover there. In terms of his tax saving, yes, I also agree that you do tax saving funds to the extent of the tax benefit that you would get. But to the extent of tax benefit that you would get, definitely I would go and invest the ATC completely, so that I'm not missing out on, because anyway they are all equity funds, plus I'm getting a tax benefit out there. So utilize it fully. But once you've exhausted that, keeping in mind other insurance, PF, etc., then you stop investing any more into ELS's fund beyond that point.
Well, next up, we've actually got an email from Amit. He's 29 years, self-employed, who writes into us. I'm just going to take you through what he has. The insurance side, he owns HDFC Endowment Insurance Policy for about 15 years starting 2006. He owns the endowment maturity benefit of ₹3 lakhs, LIC New Bima Gold, HDFC Ergo Health Policy and HDFC Critical Illness Plans. Till now he wants to know which mutual funds he should be investing in. So what do you make of his insurance portfolio, and of course what mutual funds should he be looking at?
Yeah, actually before he looks at mutual funds, I suggest he ramp up his insurance cover. One, because he is self-employed, so his income stream may be irregular. So a good insurance cover is a prerequisite. The two policies that he has, they provide him with too low an insurance cover, and besides they mature too soon. For instance, even if he has taken it this year, he's only 29, so they'll mature by the time he is 45. So what I suggest is he take an insurance cover of a reasonable amount. Today you have a lot of good online term insurance plans which provide a very healthy cover for a low premium. ICICI iProtect is one good plan, and otherwise there is Aegon Religare iTerm and also Kotak eTerm. I just calculated that if he chooses ICICI iProtect for just around 18,000 rupees a year, he can insure himself for 2 crores for a period of 30 years, which is a reasonable amount. Once his cover is in place, only then he should look at funds. And given his age, I feel that he could invest around say 65 to 70% in equity. But this is just a thumb rule. And if he chooses mutual funds, he could choose some of the well-performing diversified ones. I would suggest say Franklin Blue Chip, Fidelity Equity, DSP Equity or IDFC Premier Equity. So any of these he could choose, but insurance cover is primary.
Right.
Yeah.
Right, Anil, you agree insurance cover is primary and that needs to be sort of looked at before the investor can actually look at mutual funds at all. And if, of course, you can also tell him what mutual funds are you advising on.
Sure, I would agree, because you actually need to take care of the foundation of your investments, before you actually start looking at the actual investment product there. So the life cover definitely is something which one needs to look at, and especially since one is a businessman, typically there may be loans which are there, so please ensure that you cover all your loans with a term cover. Also, look at what is the corpus that the family would need in case of a life risk, and the assets that you have, and then put the rest of it into looking at what is the term cover that you need. The cost of term cover is again very marginal, so you can actually end up going and taking some reasonable term covers, and I think Jayant already suggested some of them. They're good things to look at there. In terms of the mutual funds, one would like to look at a combination. Again, I'll be a little conservative there, considering his business background, just to keep some bit of liquidity just in case it is required there. So I would do a HDFC Top 200, a Franklin India Blue Chip Fund, maybe a HDFC Prudence, which is a balanced fund, and a little more conservative Franklin India Dynamic PE Fund. So that is something which, let's say in case he actually needs liquidity there, may end up getting it, because the fund ends up having a asset allocation between debt and equity depending on the market PE. So the higher the PE, the more it is into debt, and the lower the PE, if markets fall, then it goes more into equity. So something like this will also protect from a downfall, and in case the liquidity even required at that time, maybe you would have that without too much of a loss out there.
All right, gentlemen, it's been an absolute pleasure to get your comments on the various stock or the various mutual funds insurance queries that our investors have been continuously posting, and that's been our endeavor to upgrade the level of knowledge and even to bring them the right advice on how should they navigate through this broad and complex framework of all the funds which are out there in the universe. Thank you so much for your time. Before we let you go, let's get your disclosures as well. Jayant, first to you.
Yeah, me or my company's clients, we may have holdings in any of the schemes that I mentioned.
Anil, what about you? Your disclosures as well, please.
Sure. Yeah, most of my investors as well as my clients and myself would hold a lot of the funds that we are actually recommending on the show.
Hi, thanks Anil, and thanks Jayant for joining us today on the show. Indeed a pleasure to get your views on the mutual fund and insurance queries. That's all the time we have in this edition. Thanks for watching.
Stay with us. Power Lunch is up next.